What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Pinterest stock because this stock was up over 3% today because news came out that they raised their guidance for revenue growth. So that's pretty good. If you don't know, Pinterest is kind of a mix of a couple different things. It's a social media website, it's a search website, and it's a commerce website. So that's how they describe the mix of it, kind of. And this is what the website looks like. It's pretty much just a big feed of different stuff you can pin, and whether it's shirts, memes, whatever it could be. So Pinterest went public in 2019. So it's not a super old company. The market cap is now $18 billion. And the first thing we're going to look at is their revenue. So the revenue growth is surprisingly stronger than I expected. However, the revenue growth for this year and next year are a lot slower than what they've been doing, because in the last 5 years, they've averaged 42% growth. But again, after the pandemic, like most other websites and companies, the growth slowed. So the last 2 years, we were looking at a 28% growth on average, and in the last 1 year, it only grew 8%. And then I think next year, it's expected to grow like 14 or 15%. So maybe it picks up a little bit, but overall, the trend is pretty strong. As for net income, it's a different picture here. We have not much consistency, and it's still negative. So that's a problem. So that's going to get a no. With that being said, there is no price to earnings, but if we check the price to sales, we can see that at one point during the big hype cycle in 2021, it traded as high as 23 times, which is kind of ridiculous. And then it came all the way down to a 4, and now we're at a 6. And it looks like it's been hovering around this 6 area for over a year and a half now. So this is probably a healthy range for it. Although, I mean, if it's growing close to 30%, I think paying 6 times is totally fine. But if it's only growing 5% or 10%, I think 6 times is too much. So, but as long as revenue growth picks back up, then it makes sense why you'd pay 6 times sales. So overall, I'd give that a check. Is it innovative? Yes. Not only are they using artificial intelligence with a lot of their different things, but just what they're doing as far as a social media app and a website goes, where they're combining commerce, social media, and search, I would say that's an innovative thing. Strong market share, yes. We're looking at 14% in the United States for social media sites and 6% worldwide, with almost 500 million monthly active users, which is a ton. So that's definitely a good number. Return on invested capital is negative. The equity is growing. However, in the last 12 months, it's actually been going down. So the last 4 years, or let's say 3 years, 2019 to 2022, the equity was growing very nicely, 2 billion to 3.2 billion. But for over a year now, it's gone from 3 billion down to 2.6 billion. So I mean, it could just be because they probably had some debt. They're a somewhat newer company and they're not profitable. So once interest rates went up, that probably had a negative effect on that, as it does for pretty much every company out there with debt. So that's probably what it is, but still, it's not a good sign, because then you have them paying, you have the debt, you have them not making a profit. Then that leads to, we're about to get into it, the decreasing or increasing share count, diluting shareholders, raising money that way. And it's just a big downward cycle. So that's not exactly what I want to see, but it's kind of understandable for companies that are somewhat newer. So overall, the equity, I put yes, it's growing only for those 2 to 3 years, though. In the last 12 months, it's been weak. It is not over 15% of the market cap. It's kind of like 13 to 14%. So that's going to get a no. Share count decrease, how I said, it's been averaging 8% increasing per year. So this is not it's not the end of the world, but it's just not ideal. It's not what we really want to see. It's not helping out the stock price. The assets, now here's something that's interesting. With not only this company, but other companies that are in this stage of where they're like maybe 10 years old, 15 years old, and they're not profitable yet. A lot of them have fantastic ratios of assets to liabilities. This company has 3.2 billion assets and only 500 million in liabilities. So that's really good. That means they are paying, let's see, that means they are paying off their debt, right? And their expenses. So that's a good thing. That's that's showing improvement. So really this equity should be growing. It's probably because they're also investing lots of cash back into the business. So that definitely gets a check. The margins are negative. Cash and receivables of 2.8 billion, which is very healthy for an $18 billion company. Definitely more than their income. And no dividend. Over 10 years old, I believe 2008. Yeah, 2008 it was founded. And then we're going to get into free cash flow, and we're going to see that it's kind of similar to net income where it's not really ideal. Here's something interesting too. Here's free cash flow. Okay. But then when you factor in how many shares they issued to dilute shareholders, this free cash flow turns negative, right? The chart doesn't look as good anymore because it's when you factor everything in, the free cash flow is a negative. So that's not good. That's not good. I would, and see they also got their price target raised from Citigroup from $31 to $36. So that means it's got that means the stock could go up quite a bit from where it's at right now. And I would be interested in this company because I can see this company sticking around for the future. But at the same time, I don't like investing in companies that aren't profitable, and I don't like paying even $18 billion is kind of a lot for a company that's not profitable yet. So if they were doing like maybe a couple $100 million of net income, then that would make more sense. Or if the stock was really beaten down, like if the stock fell to 10 billion or something like that, then maybe it'd be worth taking a chance on. But at this point, I'm still not too interested. So thank you for watching. I will see you guys in the next video.